You ever wonder how something happening halfway around the world can, well, reach right into your bank account? How a conflict thousands of miles away can actually change the price of your mortgage? That's exactly what we're going to unpack. We're going to follow this surprising chain reaction that connects a global headline directly to your closing costs.
So just for a moment there, homebuyers had a real reason to be optimistic. I mean, for the first time in over 3 years, mortgage rates were finally looking good, dipping down to a multi-year low. It really felt like the perfect time to jump into the market. But then, poof, just as fast as that good news showed up, it was gone.
And the whiplash was real. I mean, just last week, the average 30-year fixed-rate mortgage dipped below that magic 6% number. And then, by Tuesday, bam! It surged all the way up to 6.15%. Now, that is a huge jump in just a few days, and it left a ton of potential buyers feeling pretty let down and, honestly, just confused.
So, yeah, what in the world just happened? How do you get such a crazy, dramatic reversal so fast? Well, it turns out the answer is kind of like a fascinating economic detective story. So, let's follow the clues.
Okay, so to crack this case, our first stop has to be the most direct culprit, the bond market. This is really where the first tremors of that rate hike were felt, and it all revolves around one very important government bond.
So we're talking about the U.S. 10-year Treasury yield. Now, that might sound complicated, but all you really need to know is that it's a huge benchmark that influences all kinds of loans, especially mortgages. And right before mortgage rates shot up, guess what happened to this yield? It jumped back above 4%. And here's the key takeaway. When that number goes up, you can bet your mortgage rate is going to follow right behind it.
Okay, now this is where things get a little weird, a bit counterintuitive. See, normally when there's chaos in the world, investors get nervous and they run to safety. And for them, safety looks like U.S. government bonds. So they all buy bonds, which pushes the price up and pushes the yield down. And lower yields, that should mean lower mortgage rates for us. But not this time. This time, a totally different kind of fear flipped the whole script and did the exact opposite.
So what was this other fear, this thing that was so powerful it flipped the entire bond market on its head? It all boils down to one word that makes pretty much everyone from economists to everyday folks really nervous: inflation.
And you don't have to take my word for it. Senior economist Joel Berner put it plainly, saying the sharp rise in that Treasury yield means that fears surrounding inflation are the stronger effect. In this economic tug-of-war, inflation fears just won.
Okay, so what was the smoking gun? What specifically lit the fuse on these massive inflation fears? Well, the answer lies in the one commodity that basically powers our entire world and has a huge effect on the price of, well, almost everything. We're talking about oil.
And just look at that number. In one single day, the price of Brent crude oil, that's a global benchmark, spiked by more than 8%. That is a massive, attention-grabbing jump that sent some serious shockwaves through the financial markets.
To put that in real dollars and cents, at its peak on Tuesday, we're talking nearly $85 for a single barrel of oil. This isn't just some abstract percentage point, it's a real price shock with very real consequences.
And this quote from Joel Berner really connects the final dots. Why does an oil spike spook investors so much? Because oil is everywhere. It's used to make and transport almost everything, from the gas you put in your car to the plastic in your computer. So when oil gets pricier, everything else does too. That's the looming inflation that scared bond investors into selling, pushing yields up and taking your mortgage rate along for the ride.
So, we followed the trail of clues, from your mortgage rate to the bond market to inflation fears to the price of oil. And now, we get to the final piece of the puzzle. What was the event that kicked this whole thing off? According to reports, the trigger was a U.S. strike in Iran that took place over the weekend. This single geopolitical event is what the markets were reacting to. It was the first domino to fall in the economic shockwave we've been tracing.
So, why did this one event have such a massive impact on oil prices? Simple. It's all about location, location, location. A full 1/5, that's 20%, of the entire world's crude oil supply has to pass through a tiny little choke point called the Strait of Hormuz, and it's right next to Iran. So any conflict there puts a huge chunk of the global energy supply at immediate risk.
And this is a really important point. Iran itself only produces about 3% of the world's oil. But because of where it is, it has potential influence over a whopping 20% of it. So the fear isn't just about what Iran produces, it's about what it could disrupt.
So now that we know how we got here, the big question is, what happens next?
This whole situation has injected a giant dose of uncertainty into the market, and that instability could have some major implications for anyone even thinking about buying a house.
And here's the expert take on that. Joel Berner warns that if this conflict leads to long-term inflation, then this rate spike we just saw might not just be a temporary blip. It could actually be the start of a whole new trend of higher borrowing costs.
So what should we be watching? Well, the future of mortgage rates really hangs on a few key things. How long and intense does this conflict get? How do global supply chains react? And what happens, specifically, in that critical waterway, the Strait of Hormuz?
Looking forward, we're really seeing two different stories about what to expect. On one hand, the White House was predicting that high oil prices would be a short-term thing. On the other hand, the market seems to be getting ready for a period of real volatility and uncertainty. So for homebuyers, the message is pretty clear. It might be a bumpy ride for a little while. Which really leaves us with this final thought. We just drew a straight line from a military strike in the Middle East all the way to the interest rate on a loan for a house in America. It's just a powerful reminder that in our modern, super-connected world, no major event is ever really that far away, is it?